G'day and welcome to the Investor Motivation Podcast. And this is our first one for 2024. Welcome back, Amy.
It is. Welcome back. It is the 23rd of August, so we are a little bit behind in getting this one going since returning to work. But
What date is it?
what did I say, 23rd of Jan?
Of August?
My birthday's in August, maybe I'm thinking about that.
Yeah, it may well be. I'm not even sure you said August now. Let us battle on. We are so rusty. We've been on holidays. Did you have a good break?
Yeah, it was much needed, I think, and yeah, feels good.
Clearly. So obviously our first one for the year, we thought we'd reflect on last year.
Yeah.
Looking backwards about learning. So not looking back and saying, obviously I've been in the industry coming up 26 years and I think over the last 2 years, again, I've become, I think, a better advisor.
Yeah.
Definitely from a emotional, psychological point of view to be able to help guide clients.
Yeah, we've definitely taken more of a focus on, I think since I started, which was coming up 4 years ago, we're now more focused around the holistic, psychological, emotional retirement, more than just money, that goals-based advice.
Correct.
Stuff.
Yeah, and that was obviously Amy that exposed me to some extra, also better, deeper levels of thinking around, that you can actually be overfunded for retirement.
Yeah.
And if you're substantially overfunded for retirement, then potentially you're sacrificing the now and the fund that you may have by just feverishly save,
Yeah.
and not quite living perhaps you're having the freedom now that you have.
Yeah.
Why perhaps the kids are still at home and those sort of things, whilst you're desperately trying to save for retirement, and not perhaps living the life you may want right now.
And I think it is hard as financial advisors. We are focused and very motivated by accumulating wealth and seeing that figure grow, perhaps to the point where we do restrict the way we live now because we just are focused and motivated on increasing our wealth and money. Yeah,
for some future, I suppose financial independence in retirement was probably, in my mind, is always, that should be the end goal for myself and my clients. But gee, there's a fair bit of time and fun to be had between 18 through to that retirement.
Yeah, 18 to 67 is a long time.
Yeah, and that's also a big part of the, making sure that there's less regret for people, as we get older. And because I think regardless of what money and wealth we have, having, when we're too old, regret for what we didn't do or should have done will eat us alive, not how much money we've got.
It's just finding that perfect balance of having fun now while making sure that for the next, from retirement 67 to 100, if we project out to life expectancy, that we do have enough money then as well to live comfortably. So it's having fun all the time.
Well, that's right. And I remember I saw Billy Connolly, the comedian, many years ago, and he was talking about how he just loves white bread.
Okay.
And he said, look, I know brown bread and multigrain's probably good for you, but for me it's like a freaking frisbee. Don't want it, not interested. And yes, it might make you live a little bit longer, but it's going to be when you're 80 and not going so well, or 90. It's not going to be, and this is Billy's words, not when you're 18 and shaking your brains out. So
I get the metaphor.
So it's pretty clear. So when you get that extra time from eating all the delicious multigrain bread, well, it's probably not in your prime.
Yeah. Prioritising.
So let me do the acknowledgement of land, and that on behalf of the Investor Motivation Podcast, I'd like to acknowledge the traditional owners of land which we record the podcast. Pay our respects to the elders past, present and emerging.
Perfect.
Amos, where do we start? What have we learned?
Well, now that it is, end of January, we've got to think back a little bit to what did happen last year. I think for our client portfolios, we saw a massive, prior to last year, there was COVID and a crash in the markets, especially in the international area. A lot went down, and in the past 12 months, we've probably seen, since my time here, the largest increase in a 12-month period for that space.
And it was, in hindsight, as always, always pretty it was very predictable. Probably the one thing that wasn't predictable for me, and this is not just 23, it was 22 and 21, and 20, the crash. So we had the COVID crash,
Yeah.
very sharp, but the recovery was huge.
Yes.
And that's the bit that, was that predictable? None of it's predictable. So it's only in hindsight you look at this stuff. But, that recovery after the sharp crash, the recovery was so strong.
Yeah.
And of course it overshot.
Yeah, it was fueled by greed. Everyone thought, this is awesome recovery, let's get on board. And
So that's probably predictable.
Yeah.
But then it was a good 18 months of declines.
Yeah.
And of course, everyone was, let's get on board. And then over that 18 months was, oh, geez, isn't this terrible? We're below the highs we had.
Yeah.
And what was predictable is during that bear market stages, people's investors, our clients' emotions were, not everyone was relaxed.
No, not at all. It was, always the high water mark, this is where it was, and now it's coming back for, 18 months is quite a long period of time to be in a bear market.
Yes.
So people were definitely affected emotionally by that. And
and I think, we've got our little list of things that we spoke about, but obviously it's volatility. And whilst we talk the long-term game to clients and say that, it's long-term, and this is all the stuff we've said in the past, long-term, and businesses take time to grow and make their products and services better. But the markets trade every workday.
Yeah.
There's liquidity. So, the instant someone has some greed or some fear, they can click a mouse, tap their phone, and they can transact based on how their heart feels.
Yeah.
Or, oh, geez, the news is bad. I think things are going to get worse, Rob. Okay, you really don't know that. You are guessing. And generally when people think it's going to get worse from here, we've probably reached around the bottom.
Yeah.
Because the news is all bad right then, but the markets have already factored it in.
Yeah. They've always priced in consumer sentiment, how everyone's feeling. It's in the market price that day. So you might be feeling super low, but that's what is currently reflected.
Yeah. And if the market, if the media in what's hitting the news is talking about inflation and all the bad news, the markets have already thought about that. They are thinking 12 months ahead. So when it comes to, whilst we talk the long game, we give the tools to our clients to check on a daily basis.
Yeah.
So for those that are looking, they see all the ebbs and flows. So, and this is my cheeky advice from last year, is to stop volatility, is to stop looking.
Yeah.
Don't look at your portfolio.
Yeah.
And, when it's going down, that's where people get, I suppose, emotional, and it stresses them. And so I said, stop looking and then go and do the stuff you like. And I suppose the other quote that I've come up with, that your job in retirement is to do this, increase the memories by doing fun stuff, to reduce the regret down the track when you are too old to do stuff.
Yeah. No one's sitting on their, deathbed thinking, yay, I've got $2 million in my bank account, but I haven't had any fun my whole life because I've been saving.
Yeah.
Yeah.
Or I've been busy hitting enter and refreshing my portfolio on an intraday basis.
Yeah.
Unless you think that's awesome fun, the advice is don't do it.
Yeah. Do you, being an advisor and understanding volatility in the markets, do you look at your portfolio personally on a daily, weekly, monthly, yearly?
Well, psychologically, I'm the same as everyone else.
Yeah.
I don't look now whether it's going up or whether it's going down. But years ago, when it goes up, you go and have a look.
Yeah.
And when it went down, you ignored it completely. But as I say, it just takes time for businesses to do what they do.
Yeah, that's right.
And that dictates the long term. The short term will be dictated by the world's calamities, by natural disasters, by things that happen, wars. That's what will dictate the short term.
Yeah,
uncontrollable
things.
Long term will be dictated by all the amazing people that run amazing businesses that are really devoted and hardworking to make things better.
Yeah.
It's human endeavour.
Yeah, definitely.
That doesn't change. What about you, Amos?
How often do I check?
Well, yes, or the next learnings that for you as a younger advisor. But how often do you check?
I these days I don't have a huge portfolio to check at the moment. It's, work in progress.
Yes,
but
you're 25.
Yeah.
Yes, yep.
Having fun.
Yeah.
And I probably only check my portfolio when I think about investing again.
Right.
I don't know why that is, but if I've got money set aside to invest, I'll check how my existing portfolio is doing. But if I am just saving the money away and I'm, living life, I will not check it at all.
Yes. Yep.
But yeah, the moment I want to add a stock holding or something, then I'll check it.
Okay. Yep.
And I don't know why, because the existing portfolio isn't going to impact the future, holding I'm going to add or anything.
Yes. Yeah. Fair enough. All right. What's up next?
What else happened last year? We had a great 12-month recovery in the international markets. Interest rates have haven't increased since last year. So economists are thinking that there may be a peak there, and that's potentially why we have seen such a great increase in the last 12 months, because people were so pessimistic about what was going to happen with the interest rates, and it was going to keep going and keep going. And then as soon as those monthly increases stopped, people were relaxed and markets went up.
Yep, and markets preempted all this happening before it physically happened. I think that's part of the thing that rising interest rates are negative for all asset classes.
Yeah.
And lowering interest rates are like helium for asset prices.
Yeah.
Good. I think for me that one of the key things from last year, and I suppose I've instinctively known this, that when you buy matters. So over the last 3 years, where new investors have come in and purchased things, build a portfolio, we've purchased, and we've got it at a high.
Yeah.
And then it's gone down during that bear recovery, and then it's a year and a half, 2-3 years later, you just sort of get back to where you were.
Yeah.
So it hasn't been a great experience in the short term, and that short-term experience matters a lot.
Yeah.
And there's other clients that came on, say, just as little as 6 months or 12 months after those previous clients. Their experience is like, holy wow, that's
Shut the lights out, Rob.
Yeah, aren't you? You are incredible. And I
Yep.
think, well, it's just a timing issue. So when you buy does matter, and having patience, which is very hard to, sometimes I think my clients are paying for the experience and the patience that I've got to wait.
Your mentorship in guiding and just letting them feel calm, because you are calm, because you know what's going to happen. And
I don't.
Well, not so what's
Yes,
going to happen,
yeah.
but that volatility will always be there. And you just reiterate that over and over. And
Yeah, but there's times in the past where people are just watching markets go up and just can't tolerate being in cash. Why isn't it all in? And things. And I see what's happened now. Some of our portfolios in the international share space, and this is last year, so it means absolutely nothing moving forward. It's been up, up to 50% growth.
Yeah.
You get a little bit lucky with a few semiconductor businesses, things like that, like Nvidia, that really just make a huge difference to a portfolio. But the chances of that happening in the coming 12 months, I would say, is next to nil. It's not, after a big run up like that, there's more likely a correction.
Yeah, and I think that's probably, personally, you always hear about, it's not about timing the market, it's about timing the market. And that is true over in the extremely long term, definitely. But I think I probably have learned that it's fine to have money set aside in cash to wait for the times when people are extremely scared and fearful, and not saying there's going to be another, COVID crash in the next 10 years or anything to that extent, but that it does matter when you purchase. It
does matter, and it's the short-term
in the short term.
Yeah, the short-term experience I think sort of dictates how people feel about a spot you invest. So you really do want that initial experience to be quite good.
Yeah.
So people coming to me now and say, Rob, I've just sold the farm, let's invest money. I would say, great, let's take our time.
Yeah.
And
relax that excitement a little bit, because people, you always hear that, shares go up 10% year on year on average. But I think being advisors, sitting in cash isn't as good as that return, but it is also okay to hold it in cash and wait a little bit and be patient.
Yeah. And keep in mind, when we invest, we do risk profiles for our clients, which I'm not big fans of. I think they're a poor excuse for lack of education, but it's not just all share market. We hold lots of term deposits. We need cash to pay pensions. You need money at home to help you sleep at night, all those types of things. Now, I suppose what we're chatting about here is obviously Charlie Munger died last year.
Yes.
6 weeks prior to his 100th birthday. Amazing effort and worked
Amazing.
all the way through. What a contribution he had to the investing world. Amassed extraordinary wealth himself by being disciplined, by buying and holding for a long time. But there was a favourite quote, which I've definitely mentioned in the past, from Charlie Munger. And Charlie Munger was Warren Buffett's business partner at Berkshire Hathaway.
Yeah.
And the quote is, "The money is not in the buying or selling, but in the waiting." And that, I think,
The long-term philosophy.
were two parts. I believe it. I believe that quote means two things. The waiting is, holding great businesses for a very long time, but not in the buying and selling, but the waiting. So it means
Waiting.
hold it, but also possibly waiting for, and this is what Charlie and Warren have been brilliant at doing, sitting on cash for years on end and waiting for those times when people are fearful.
Yep.
And then they pin their ears back.
Brilliant.
Very good.
What else happened last year?
Oh, so much stuff. On the back of our sheets, you've got some awesome stuff there on how much super is required for a comfortable retirement.
Yeah, so this is, I guess, plays into the more psychological aspect of how everybody thinks about money. And I had a client who was with ANZ Super, and this client didn't have a whole lot of money in their account, and they were freshly retired, had about $40,000 in super because they had, run a business their whole life, been self-employed, and use their money in other ways. And they had on their superannuation annual statement that came out, it said, "How much super should I have at my age for a comfortable retirement?" And keeping in mind his really low balance, it said that somebody born in his year should have a balance close to $584,000.
Right, and he had 40, did you say?
40, yeah.
So how did that make him feel?
Well, that's exactly what I thought. Imagine reading that, thinking your whole life's work and worth and how you're going to live for the next 40 years is dependent on your superannuation balance, which when, super has no idea who you are, how you live, what you do, and they've just got this flat dollar figure across the board for everybody in that age bracket.
Yeah, okay. And then, Amy, obviously, this is about, that overfunding thing, that if you have, a modest, income needs, a modest lifestyle, you actually don't need that much to be happy.
No, we've structured a financial plan for this person, and it's based really around having about $200,000 in liquid assets, and they're going to live their modest lifestyle easily.
Right.
So it's no worries that they don't have that $600,000 around about figure in their superannuation, and
that's because his income needs are just not that high.
No.
So he picks up a generous age pension from the government.
Very big help having that backstop in Australia, that age pension, definitely.
Yes. And some of the numbers that you've got here, and this is it AFSCA, where it provides the, I suppose, direction on what is a comfortable amount for retirement. And now this is say a single to live a modest lifestyle in the first 2/3 of their retirement. So a modest lifestyle is $32,000 per year. And that's sort of at the start of retirement, and that's where they are saying it's about that number. It's 595, and then later on down the track, it's someone around the age of 85, it's around 30 grand. So the amount that you need comes down substantially. But if you're getting, was this chap a single or a
single?
Okay, so he'd get around 28 grand per year. And
age pension.
And if you just need an extra 10 grand, and he gets some earnings on his 200, he's fine.
Definitely.
And I think that's where some of these numbers can be misleading and not make people feel that good.
And so just to reiterate that, so the single modest lifestyle is the 32 per year for between that 65 to 84-year-old, where you are probably spending more money and being a little bit more active with your time. And that lump sum superannuation at age 67 is 100,000 for the modest retirement.
Right.
Comfortable retirement, which for a single from 65 to 84 is about $51,000 a year. And then the lump sum does go up if you want to meet that standard, which is that 595
So
figure.
I read that a little bit incorrectly. So so a comfortable for a single, they're saying, is 51.
Yes.
And you need at 68, at 67, you need nearly 600.
Yep.
But if you are very happy on 32 and a half and you're 65, you only need 100.
Yeah, because we do have that age pension, and it's amazing help.
Yep. And it's the same for a couple on a modest lifestyles as well, which is up to 46 grand.
Yeah.
Because 43 of that will come from age pension as a couple. You just don't need much else.
No.
Yeah. Yeah, we're in the lucky country.
We definitely are.
Yeah, very good. I think last point that I'd like to cover off on is, particularly when, people that are interested in the markets and they need to be invested because inflation always poses a risk.
Yeah.
Rather than just sitting money in a term deposit.
Yeah.
That inflation is not a problem in the short term.
Yes.
But long term, if your money's sitting in cash, your money is going backwards, and therefore you need to invest into assets that can grow, that are often on the share markets around the world, great businesses. You just have to get used to volatility.
Yeah.
Volatility is normal. The way to fix, and so volatility is not a worry for you, is stop looking.
Close your eyes.
Close your eyes. Go and have fun. Do the stuff you like.
Yeah, definitely.
Excellent.
With ya.
Very good. Thanks, Amy.
No worries at all.
First one for 2024, done and dusted.
Yes.
Please provide us some feedback. If you have a topic you'd like us to have a crack at, we would love to do that.
It's probably also a little plug moment. Rob is now on TikTok.
TikTok, yes.
And Instagram?
Not so much.
Not so much.
Yeah, I'm
Not
there.
Yet.
But probably TikTok is been an interesting and fun thing to do. I'm trying to make sure that when I roll up to work that I'm doing I sit in the car and record a video on a topic that I hope people find is interesting.
Yeah.
I did one on donuts at the Vic Market on the weekend because they're delicious. 2,000 views later, Amy.
Wow.
Impressive.
Where
completely non-viral. But again...
And is this a TikTok about donuts or is it financial related?
Oh, it's absolutely financial related. It's how I would invest my last $2.
Oh, in a donut.
Absolutely. Any plugs for your socials?
No, not at this present time. But what's your TikTok handle where people can find you?
I think it's at Rob Gowdy.
Rob Gowdy, perfect.
Yeah, there is Rob Gowdy. There is a financial advisor there to answer questions, which I've had some comments already, which has been nice. TikTok, the technology is incredible. Make it very simple to reply to someone's question.
Yeah.
But on our website, there is the Peter Thornhill video series that is called. It's under online courses, investing in the right asset class. There is lots of things. People for mortgage stress. I did this many years ago, but the information in it is still appropriate.
Yeah.
So there's so much information there on our website, Consortium PW.
Yeah. And you've also got a live webinar coming up at the end of the month. Yep.
Correct.
Selling the Farm?
Selling the Farm. That is next week on Wednesday. If this one's getting produced and comes out a bit late prior to that, every couple of months I'm doing one.
Yep. So head to our website, go to the Selling the Farm page, and there'll be a link to watch the next one. Yeah.
Once I finish next week's, there'll be another one there. Lots of education, lots of information. That's how we do things. We want to help people and educate.
Yeah,
cool.
But let us know always if there's anything else you'd like us to cover off on.
Fantastic. Thank you, Amy.
Thank you, Rob.
Cool.
Thanks, everybody.
See ya.
Bye.
Bye.